Are you getting tired of watching the market's endless roller coasters? Just wishing for a more predictable way to get a return on your investments? Well, you are in the right place. In this explainer, we are going to demystify dividend investing and break down how it can actually work as a source of income.
Okay, so let's be honest. It's a challenging time for investors, right? Finding that steady, predictable source of income from your portfolio, well, it feels more important and, frankly, a lot more difficult than it used to be.
You know, this quote just nails the feeling right now, doesn't it? We're seeing turbulence from pretty much every direction. You've got geopolitical risks, soaring oil prices, and all of it is weighing on the market. It's enough to make any investor feel a little anxious.
And that brings us to the big question, really. In a world of constant ups and downs, where on earth can you find a more predictable return? Today, we're going to explore one potential answer to that, and that answer is dividends.
So here's our game plan. We'll kick off with why the search for income is so key right now. Then we'll cover what dividends even are, how to read a company's dividend scorecard, the classic tug-of-war between stability and risk, what's happening in the broader market, and we'll wrap up with your key takeaways.
So let's start at square one. What exactly is a dividend?
Honestly, it's pretty simple. When a company makes a profit, it basically has two choices. It can reinvest that money back into the business to grow, build new factories, hire people, or it can give a slice of that profit directly back to its owners. And who are the owners? The shareholders. That payment is the dividend.
I really like to think of it as a literal cash thank you for being an investor. It's a direct reward just for owning a piece of the company. It means you're not just sitting there crossing your fingers hoping the stock price goes up one day. No, you're actually getting paid in cold, hard cash along the way.
All right, so how do you actually figure out if it...
Thanks for watching. If you enjoyed this video and want to see more investing content, tap that like button and make sure you subscribe to the channel.
Along the way.
All right, so how do you actually figure out if a dividend-paying company is a good investment? Well, you need to know how to read its scorecard, and that really means looking at a few key numbers. The first and definitely the most famous metric is the dividend yield. All this percentage tells you is how much cash you're getting back each year for every dollar you invest just from the dividend. It's a really quick and easy way to compare the income potential of different stocks.
Now, to make this real, let's just look at an example, the medical device company Medtronic. Right now, it has a dividend yield of about 3.3%, so that gives you a tangible benchmark for what a large, established company might be paying out.
But, and this is a really big but, a high yield isn't always a good thing. Sometimes it's a trap, and that is exactly why we have to look at our next metric, the payout ratio. This tells you what percentage of a company's profits are actually being paid out to you. Is it a small, sustainable slice, or is the company stretching itself really thin just to make those payments? For example, take a look at Unipresident, a major food company. It has a payout ratio of over 92%. That means it's paying out 92 cents of every single dollar it earns. Now, first glance, that might look amazing, but it raises a huge question. Is that sustainable? I mean, what happens if they have just one bad year? There's no cushion.
And, yep, this chart of their dividend history shows you exactly why you need to be cautious. After a massive 161% jump in 2018, look what happened. The dividend was cut by more than half the very next year. For an investor who's looking for reliable income, that kind of volatility is a major, major red flag.
So this brings us right to the core challenge of dividend investing. It's all about balancing that desire you have for stable income against the real-world risks of the business you're investing in.
The crucial point here is to really understand the underlying business. On one side, you've got a company like APA Group. It's described as a steady toll road operator for energy. That super stable model has allowed it to increase its dividend for 20 consecutive years. Then, on the other side, you have a mining giant like BHP. Its profits swing wildly with the volatile nature of commodity prices, which makes its dividend way, way less certain.
And that's really the key takeaway here. For an income-focused investor, a long track record of raising the dividend year after year through good times and bad is a huge green flag. It signals a stable business and a management team that's totally committed to rewarding its shareholders. Now, let's zoom out for a second, because no stock exists in a vacuum, right? The entire economic landscape for dividend stocks is shifting, and it's really critical to understand why. For years and years, if you wanted income from your investments, dividend stocks were pretty much the main game in town. Well, that's not really the case anymore. They are now facing some seriously stiff competition for investor money from other places that are suddenly offering really attractive returns.
This chart shows the trend perfectly. Using the Australian market as an example, you can see the average dividend yield is now a full percentage point below its 10-year average. So what does that actually mean? It means investors are having to pay more to get the same amount of income.
And here's the main reason why. As Morningstar points out here, rising interest rates mean that other, often much safer investments like government bonds are now offering yields that can actually exceed what you get from the average dividend stock. And when a very safe investment pays you more than a riskier one, well, income investors suddenly have a real choice to make.
Okay, we have covered a lot of ground here. So let's boil it all down to the key takeaways you absolutely need to remember.
First, dividends are your share of the profits. Simple. Second, please don't be seduced by a high yield alone. Always check the payout ratio and the history for consistency. Third, know what kind of business you're investing in. Is it a steady, boring toll road or a volatile commodity producer? And finally, remember the big picture. Dividends have competition right now.
So I'm going to leave you with this one final question to think about. When a company pays a consistent dividend, is it a sign of financial strength and discipline? Or is it maybe a sign that the company's just run out of exciting new ideas for growth? There's no single right answer, of course, and that debate is right at the very heart of dividend investing. Thanks so much for tuning in.